You called this earlier when you came on set with us to talk about Turkey. Everyone was saying, is it idiosyncratic? You said this is a big risk. What's the contagion effect longer term?
So, first of all, we have seen this movie before. So this reminds me exactly of when Mahathir Mohamad from Malaysia in 1997 blamed currency speculators for the problems in Malaysia during the Asian financial crisis. It was 1997. This is a result of Turkey increasing its debt. There was an IMF report that was put out last year, and it showed a matrix of countries that were repairing their central government balance sheets and those that were not. And there were 3 countries that were in the far right-hand quadrant that were not repairing the balance sheets, where debt was going to increase even with record low interest rates. And those 3 countries were the United States, China, and Turkey. Right? So this is a fundamental problem of that they have taken on too much debt. Their banks have used the debt market to finance themselves. A lot of dollar-denominated debt has been issued, and that, to me, is really the crux of the problem. And so the playbook is that there is more contagion to happen and more bad market reaction to happen over the next several weeks before this finally plays out.
And so contagion, what does it look like? What does it look like in the immediate
and here you've all brought up a really good point, which is that not that many people hold Turkey anymore. So the idea with contagion, of course, being you sell your good assets to fund your bad assets, and that's what causes the contagion. So here I think it could be further speculation against the lira, and then speculation that leads to, like you were saying, some of the European banks that are exposed to Turkey. And then that's going to get them to look under the hood. Bank of International Settlements just put out a report on Asian debt in general. A lot of it is financed by European banks. So there's definitely more contagion that could happen here.